Welcome back to Real Estate Radio TV, the commercial real estate focused media for a new interview. In today's interview, we have the honor to welcome Mazzie, co-founder and managing partners at Southern Waters Capital, a sunbelt focused investment firm specializing in value creation through land rezoning, ground-up multifamily, build-to-rent, development and investment. In today's interview, we are going to tackle many different topics, including creating value through land rezoning, turning raw land into shovel-ready for developers, the current exit market for this type of value creation strategies, as well as the growing momentum for the U.S. build-to-rent sector. Ray, how are you today?
Doing great. Thanks for having me.
It's a great pleasure. So before we dive in and tackle all the great topics we've planned for today's interview, I want you to give us a brief overview, a brief background, business background of yourself, as well as Southern Waters Capital, the type of investment you're operating in at this stage of the cycle.
Yeah, definitely. So, like you said, I'm Ray Mazzie. I'll give you a brief synopsis on who I am. Basically, attorney by education, certainly don't practice. Went to business school, worked for the governor here in the state of Florida for a short period of time, and then practiced as an attorney dealing with real estate and estate planning and taxes. So got a lot of exposure to the real estate space there. And then after that, ended up in the startup world where I met my now business partner, who I was actually employee number one for one of his portfolio companies. I'm proud to say it's still a going concern. And, after my equity vested, we had a fun conversation about what I wanted to do and what he wanted to do. And that's when Southern Waters Capital was born. My business partner, Dean Myro, he spent 30 years on Wall Street, sold. He's actually an attorney as well by education, didn't practice either. So he came right out of school in 93, went right into distressed debt trading. And then by 97 started his own firm, and by 2005 sold it to BB&T. And then he stayed on with what is now Truist for 10 years to run their capital markets and project finance. So he's underwritten everything from prisons to charter schools to assisted living facilities. So everything's just another development to him. And then we have one more partner as well, Andrew Sinclair. He has a finance background traditionally. I've known him for over a decade. He got his master's in finance. After that, went to a big shop to be a consultant to lending institutions. After a few years of that, he realized that's not what he wanted to do, so he ended up at Turner Construction as a cost analyst and project manager. Turner's obviously a global GC. So he's worked on projects as large as Blue Origin's launch complex, like $800+ million project, to smaller ones like the University of Central Florida's library. So that's our team. And then as a business, like I said, Southern Waters Capital was started in June of 2020. So this is a fun time to start a business. We dove into the real estate space and essentially realized that, focusing on rental housing is where we wanted to be. And ground up development is where we have the most competitive advantage. So that's how we ended up focusing on build to rent and multifamily land investments that we would then, instead of just selling land, we'd stay in through the entire project and either sell at CO, stabilization, or even hold long term if it makes sense for our partners. And a little secret that not a lot of people know is we also play around in the manufactured housing space as well, which will always hold a piece of my heart. It's where I cut my teeth. So with that being said, that's kind of who we are, who I am, and what we do. And yeah.
Yeah, so a lot of sectors, a very wide expertise across various sectors, and you've mentioned ground-up development, but taking it a step further, you're very well known in the space to kind of take raw land and redevelop it from a rezoning perspective to create value for your investors. I believe you've actually launched a fund dedicated to just that. So can you explain us a bit the philosophy behind this concept? What's the value proposition and also the financial upside for your investors?
Yeah, so sorry, my dog's in my office. I got to make sure she doesn't start barking on us. So the way we look at it is we keep it as simple as possible, and it's really sticking to the fundamentals. And simple, I say this all the time, simple does not mean easy. Simple can be extremely difficult. And at the end of the day, really what we're doing is we're arbitraging Main Street sellers with Wall Street buyers. Basically, landowners are the Main Street sellers. The Wall Street buyers are our co-GPs or our LPs or whomever we're going to sell the land or finished project to. And really, when you're looking, first and foremost, the market matters most, then the site location within the market, and then the actual basis you're getting in that asset, and then the business plan and team that are going to execute to bring it to fruition. I like to think the team is the box is checked, no problems there. After we decide whether or not there's a good amount of supply and demand imbalance in a market, and we're comfortable with the projected growth based on its like economic diversity and all those types of KPIs we look for that exhibit a durable market that has a lot of runway, then we'll go in. And it's simple. We want to buy land that is currently, either I call it misentitled. It's not entitled for its highest and best use, or somebody just simply hasn't brought it into the future land use. And not a lot of people know a lot of people in my space know, but I'm not, if you're just walking around, you work in a different industry, you're probably not aware of the future land use map that lies below the current land use of most dirt. And at the end of the day, sometimes there's not a lot of disparity between the future land use and the current land use. But where you find that disparity is, ag land that's actually suitable for, 8 units an acre and according to the future land use map. But right now it's just cow pasture. When we find that kind of disparity, we try to buy the asset at less than its replacement cost or market value. In accordance with its current land use, so as cow pasture, for example. And when you're buying it at below cost of cow pasture, you're already safe, you're in the money, you're not going to get hurt. Your downside risk is really mitigated there. And then from there, if you're confident that you can actually push these entitlements through, then you're going to have a much more valuable asset, as it'll be now valued. If you push it into a multifamily type of zoning regime, it'll now be valued on a per unit basis instead of a per acre basis. And obviously you're going to have more units than you will have acres, and usually you can sell those units for more than you will in the aggregate of the acreage. So that's the simple part. It's really not a hard strategy. The hardest part is finding a good piece of dirt and then getting it through the entitlement process. But really your risk is mitigated through smaller deposits, asking for more time on your contract, putting in the certain types of triggers and controls in the contract that protect you if things go down the way you don't want them to, and you lose at whatever rezoning jurisdiction you're appealing to. And from there, once you have a good grip on the zoning and everything, we're ready to close. And then at that point, now we're going back out to market to either a JV partner or to a developer who may just want to take the project off our hands for a price we can't refuse.
And you mentioned simple, not easy. It sounds like a simple concept, but it's a far from easy concept in terms of being able to execute on it. So can you explain us and give us more insight on what the process looks like between the time you execute on the PSA, the purchase and sales agreement, to actually exiting the investment? Is it capital intensive, time consuming? What are the main steps that you have to look into before getting into that type of project and operations?
Yeah, well, I really look at it in like three different pillars. You have all your entitlement risk, which I'll dive into in a moment. You have your capital markets risk, and then you actually have your project execution risk, like having your consultants work. And by consultants, I mean like engineers, MEP consultants, the GC, all that kind of stuff. So to answer your question quickly, yes, it's capital intensive. Yes, it's time intensive. And I was actually just talking with my colleague Andrew earlier, and I was like, people who don't understand what it takes to get a project through from where we start, which is unentitled land, raw dirt, all the way through some sort of stabilization or CO sale or refinancing. That developer fee that we get, it's not big enough. It's really not. I don't think it compensates for the amount of risk and time that it takes to do a project. But it's just funny. So it's if you're not in the fight every single day, you won't really appreciate how hard it is. But from the entitlement standpoint, everybody's heard of the NIMBYism out there, not in my backyard. So essentially, whenever I go in to grab a piece of land, usually the neighbors are the first ones who are mad at me. Usually the city commissioner, city council, or county council or commission, they're kind of indifferent. Most of them are pro-growth in Florida. It just has to grow in the right way, you know what I mean? And that's subjective to their particular situation, both in the city's economy and its growth pattern, and then to their constituents, who they obviously have to satisfy as well, who they need to have vote for them. So on the entitlement side, it's extremely tricky. Just the politics side of it, and that's the NIMBYism and the county commission votes and things of that nature. But then also the staff. I mean, the staff are really hard to get by. They're looking at every little thing and making sure that every little thing is right in accordance with their interpretation of what it should be. Sometimes our interpretations aren't the same, which always leads to fun conversations and usual delays, which leads to cost increases, which leads to less profits, which is not good. So there's just a lot of variables from staff to city commission to the neighbors in the area, and that's just making sure that you have the right, as I say, like the right sandbox to build upon. Really entitlements, I look at them as the sandbox with a bunch of rules and tools that you're allowed to use to make a nice cool castle, but it's the land developer like me that gives you those tools and draws that sandbox, and then it's the real builder and sponsor that's going to take it vertical. So anyway, the entitlement side is extremely tricky. You got to set everything up the right way, and it takes a while, usually 6 to 12 months, depending upon where you grab the project. And then from there, after entitlements, now you're talking about dealing with all your consultants, which happens alongside in parallel with the entitlement process. You'll see basically you'll have to work with a civil engineer, an MEP consultant. You'll have to work with attorneys and land use. You'll have to work with the local county staff, like I mentioned earlier, and architects, of course. So, managing all those consultants and handling all that is a big coordination, a big coordination effort. You're kind of leading an orchestra, if you will. And then you have to make sure that they're designing everything in a cost-efficient, time-efficient, and in accordance with the code and the approvals that you've gotten. So there's that, and then lastly you have the execution side and the execution of that plan, and then lastly the capital markets, which, as we all know, shift back and forth all the time. So when you have a development that takes a year or two to actually get to shovel-ready status, your capital markets will look completely different than when you started. I can personally attest to that. And in any event, you're just managing all these relationships and all this coordination the entire time to hopefully bring it all together in a market that's favorable to you and all your investors. So it's a balancing act. I always say it's like bowling like 5 or 6 lanes at once. Not that bowling's too difficult of a sport, but it's still hard to score a perfect score. So that's kind of how I look at it all, and what really drives the value of a developer and sponsor.
And to further be able to mitigate risk, when you execute on the purchase and sales agreement, do you put any contingencies on having the zoning pre-approved, or you just buy it as is?
So it's different with every seller. It really is. And so most of the time I just put in, there's definitely contingencies upon certain things like the zoning and entitlements. You don't always get, entitlements is a very vague word. So you'll get the land, usually you'll get contingencies for land use and for zoning. So the seller is saying, hey, we'll make sure that you can use it for what you want, but I'm not going to stick around to make sure that you get the exact site plan you're looking for. Or you get, basically, I'll know the beginnings of that sandbox. You know what I mean? I'll know how many units I'm allowed to build. I'll know my open space requirements. I'll know my ingress egress requirements. I'll know a few things. And I'll know my land uses right, which is what's most important. But past that, usually a seller doesn't want to stick around. Now, can you offer a high enough price and enough hard money deposits and other things along the way to get that? Sure. It really comes down to whether or not I think it's worth it, and whether or not I think me and my consultants can get the job done in the allotted amount of time. So Usually, like I said, you end up getting half the contingencies that you want, somewhere around there. But I always get enough time to at least get to a place where my site plan, if not approved, is in its like second or third submission, and I know it's going to be, it's going to be pretty set, because at that point you've spent hundreds of thousands of dollars on consultants anyway, so you're knee deep in this thing at that point. It's just usually it's not as favorable when you're going to the debt markets or the capital markets in general when you don't own the land outright. So it's always a balancing act between what's going to look good on your capital side versus how do you mitigate downside risk on the buy side.
And in terms of when you're acquiring the land before developing it, are you going full equity, or you're raising maybe debt? I'm guessing not from traditional banks at this stage, but private lenders.
Mm-hmm. It's a general rule to not put any debt on something that's not cash flowing. So really, the idea is to always purchase with equity. That's what we've done thus far. But I'm not saying I wouldn't do it in the right situation. Some parcels are just too expensive to lay out that much cash. But really, the best type of debt is seller carry. You give somebody a higher purchase price than they anticipated, and you just tell them, hey, look, I need a little bit of time to close on it completely. So here's 20, 30, 40, 50% down. Carry the rest until I get my construction financing, where I'll take out the rest of the debt. But yeah, it's always an option. It's just not what we're looking for.
And in terms of being a little more pragmatic, could you maybe share with us one of the projects that you've worked on where you've researched an agricultural land, got the entitlement process? I mean, what did the process look like, the time frame, as well as the financial upside for your investors?
Yeah, so we had a project in Ocala that we should be breaking ground on in the next 6 months or so, because when the capital markets got wild, we did a little bit of redesign and increased the density. But the story behind that is, I said I started out in manufactured housing. I actually went to Ocala because it was a little infamous for having a good manufactured housing market, and we ended up going there. Long story short, staff did not want any more manufactured housing, but they were happy to endorse multifamily and build to rent. So what ended up happening is we found 36 acres on the corner of 52nd and 60th on the southwest side of Ocala, which is a really great area. It's where they have all their major retailers and commercial, and it's booming on that side of town. So anyway, we found 36 acres at a great purchase price. It was $2.5 million for the 36 acres. We were able to force entitlements or force appreciation through entitlements, get the land up to zoning for 360 units. Market rate on 360 units is easily $20,000. That's a $7.2 million valuation. You could, in a good market, we would have been able to fetch more than 20. In a bad market, even if you fetched 15, you're still getting a really solid equity multiple on the land. We actually decided to stay in that deal, so we were able to, instead of selling the land, we contributed to a partnership, stayed in as a JV partner, and we'll be developing that with a pretty prolific developer, Merrimack Ventures, based out of Fort Lauderdale, where we are as well. So that project, we're able to, I don't want to get into too many details, but you're able to crystallize your return in these types of agreements, at least based off the land. And then obviously everybody's sharing in risk, costs, and also shares in profits once the deal is done. So put it this way, in a terrible down scenario where we had to sell the land and nobody wanted to build it, we would have still doubled, maybe tripled our money. When you're contributing it to a partnership, you're hoping to do much better than that. Right. So our investors are very happy, and it's a longer journey, but it's much worth the wait if you don't need the capital now, and especially when you're well collateralized or securitized, I should say. So that's kind of how we approach it, and that's kind of a simple, high-level version of the deal. But it's always unique, and it's basically, like I said, taking that raw land to a place where somebody in the capital markets wants to make a bet on it.
Right, you've mentioned the capital markets earlier. It's a topic that we hear everyone talking about, especially in today's environment. Also, we've seen construction costs rising exponentially those past couple of years, putting additional pressures on developers' margin and performance. So really, I'm curious to know is the exit market in this type of strategies, as we see all those rising costs and the decompression of cap rates also, how has that affected the overall exit market on this type of strategy?
Oh, if any developer tells you they're not getting squeezed right now, they're either lying or have some way to build that I don't understand. But we're the profits that get squeezed first, which thankfully for us, we buy the land at such a competitive price that we've been able to hold on to everything, haven't had to leave any projects. The biggest thing that's happening is your exit cap rates are just inflated, and you're setting them in the fives, mid to high fives instead of high fours back in the day. So back in the day, 2 year and a half ago. So I mean, profits are getting trimmed down, but the way we underwrite projects is, we find good locations at great basis, and we're ready to stay in or happy to stay in as long as we need to in order to fetch the best exit price. So every time we come up to a deal, we underwrite it for a decade. We want to make sure that if we have to hold the baby for that long, we're fine doing so. So we're not aggressive in our underwriting. We're conservative, but I don't necessarily need to put my exit cap at a 5.5. I might be able to put mine at a 5 because I say I'm going to stay in for 7 years. You know what I mean? I'm not afraid to hold on longer and refi and ride the market. So for us, what it's done is just we're really lucky, honestly. We already emphasized basis, location, the fundamentals of real estate, supply and demand imbalance, strong economy and growth, in population, and the right demographic for your product. We fully endorsed all those things from day one, and now as the markets have tightened and everybody's gotten shaken up, our projects are still marketable. They're still they're not as screaming hot as they were, but they have the right development spread between your exit cap and your yield on cost, and they're still penciling. So, like I said, it now just whether or not people want to stick around for the best market exit or whether or not they just want to get out. So I've been focusing on the partners who are happy to be patient, and those are usually the ones with the bigger balance sheet. So that's how I've been approaching everything. But yes, the markets are tighter, profits are tighter if you wanted to merchant build, but there's plenty of opportunity to pick up great deals if you can have a more long-term perspective.
And on the other side, we've seen a big rental growth in Florida, at least in some places in Florida, right?
Yeah, definitely. I mean, there's just not enough housing. It's that simple. And, you can still find relatively cheap housing in certain places. It's just not going to be in the major MSAs, and it's not going to be on the coast. People always say Florida's unaffordable, or I shouldn't say they always say it, they're starting to say it. And I just disagree. People just think that everybody gets to live I probably sound like an evil developer right now, but not everybody deserves or can afford to live on the coast, and not everybody can live in the city, and there's tons of great suburban areas or markets that are within a 20 to 40 minute drive of amazing job markets. And yeah, that's a lot of time to take away from somebody's day, but at the end of the day, you got to work really hard to make it in America, unfortunately now. But I think we'll all be better off for it.
I mean, Floridians says it's expensive, but when you talk to New Yorkers that are coming down to Florida, it's still very cheap.
Canadians, it's even cheaper. So it's all relative. I mean, at the end of the day, I don't like to join the pity party. I don't think about it too much because really, I let the free market handle all that kind of stuff. That's not my job. But we invest in affordable housing as well. It's just, it doesn't always pencil, it doesn't make sense sometimes. And in any event, yeah, rents may have gone up. They certainly didn't outpace inflation too much in some areas. I'm sure they did, but I find that data usually takes into account, much older supply. If you kind of compare the supply in the past 5 years to the rents of today, you got really strong appreciation in certain areas, don't get me wrong, but it's not like this doubling of rents that you hear out there. So Um, that's my point of view on that.
And another sectors you're involved in, and you've mentioned at the start of the interview, is the U.S. build to rent. I mean, build to rent in Europe is considered multifamily, but in the U.S. it's the creation of communities, single families communities. So really, what are the fundamentals making this investment sometimes perceived as a safer investment than traditional multifamilies, at least from an underwriting perspective?
Yeah, I mean, I always joke around. I think Wall Street, I think this stuff already existed. Wall Street just put a label on it so they could bring the cap rate down a little bit. But there's serious considerations that help mitigate downside risk, and usually they involve the fact that you could sell off the homes individually, or maybe you could bring in some type of rent to own program or something like that. And some companies get better credit facilities due to the fact that the homes are individually platted and are able to be sold. So maybe the risk is viewed by the credit provider as a series of individual risks and individual transactions, as opposed to one large community where you'd have to sell a whole building or something like that, which is harder to do. But at the same time, it's just that. It's just a little bit better financing. It's a little bit better, more optionality on the exit. But from there, I don't think it's that much. It's not that much better from a risk perspective. I'm sure there's other people like John Burns and Brad Hunter and all those great guys, Jay Parsons, that would tell me that I'm missing a lot of things. But from my conversations that I've had, it's really just the optionality on the exit, a little bit of optionality, and that the credit providers view it as a safer bet. Why they do, I don't know. It brings me back to sometimes it's hard for me to look through the credit provider's lens. Let's put it that way. So you should get one of those guys on your show to talk to you about it.
And that's from an investment perspective, but from a user tenant perspective, do you maybe see a growing momentum for families maybe wanting to get a single family rental instead of multifamilies, as we see, remote working? Is that maybe something that's growing?
Yeah. I mean, yeah, I hear those stories told and those things pitched. We are really a firm that focuses on our numbers and matching our product to the tenant demographic. If the tenant demographic of growing in that area is a little bit older with families, and we notice that they're kind of suitable for renting based off their income and based off the median and average purchase price of homes, it's like, okay, yeah, build to rent is a safer bet in that area. But I don't think just because people are working from home that they now want to live in a house. I think it's really people who want space and want to live in a house that can't afford to live in a house, or people who don't want to live in an apartment and need to split a place to live with their friend. It's much nicer to have a whole home, right, instead of just an apartment. So really for me, I start to lose the faith in the build to rent market when people start charging like $5,000 and $6,000 to live per month in one of these homes. I don't think the value's there. I think they'll be able to lease them up, but I think like after time goes by, somebody's going to start asking themselves, why am I actually further away from, the local amenities, the restaurants, all this kind of stuff, but I'm paying like high-rise condo pricing high-rise apartment pricing for a home. Now I'm younger, I'm 30 now, so I look at it differently. I'm sure there's people who are 40 and 50 who are like, I never want to live in a city. It'd be so much nicer to be out there on the fringe. But when you compare that type of rental pricing to the ability to buy a home in Florida, the math doesn't work for me as a renter, or for me as a home buyer. It wouldn't make sense. I guess what I'm trying to say is I think the trend to open space and free space and living in a home with a backyard and everything is certainly real, and it's happening. I just think we have to control pricing on it, and I don't mean with the government. I just mean being a good steward of what you build, because I think luxury rental communities probably appeal more to the 55 plus than they do the 35 to 55 range. I'm sure people can find data sets that disagree with me, but that's the sense that I get from living in Florida for the past 25, 30 years. So.
Right. The key is adapting and sensing the right demographic. Ray, it's been a great pleasure having you on. Before we let you go, is there anything else that we maybe haven't touched on that you want to share with our audience? Feel free to do so.
Yeah, definitely. So we have a charity that we support. It's called the Friendship Circle. My business partner is actually sitting behind me over there. Founded the Friendship Cafe, which is a really cool, essentially on-the-job training for young adults with special needs or developmental disabilities, and it helps them kind of reach their highest and best potential in the workplace, and teaches them a lot of life skills as well and other programs. So Dean Meyer is a staunch supporter of that. I'm a proud board member. And we're doing we always do an annual golf tournament. I don't think a lot of your listeners or viewers will be able to make it to the tournament, but we would sincerely appreciate any kind of support, even if it's just posting about it on social media. So if anybody could, it would be great if you went to the Friendship Circle charityclassic.com, checked it out, and if you could support either socially through sharing and talking about it, or monetarily, we'd of course appreciate any of that. And last year was a great success. We had over 100 people come out and go to the golf tournament. It was our first one we ever did. We raised, I think, $100,000, a little bit more than that, so it was huge. Yeah, any support for that would be great, and we just appreciate the time.
Well, thank you, Ray, for coming on. We'll put your different links, including your LinkedIn information, in the profile, as well as the foundation you've just mentioned. If people are ever interested to learn more about the type of operations that you do, or maybe want to invest and allocate some capital with your company, feel free to reach him out. Thank you guys for listening, and make sure you follow us on all social media platforms and download our app. That's free and available both on the App Store and Android. Talk to you soon.